Welcome to FinFactor. I'm your host, Blaine Bertsch, co-founder and CEO at Dry Run Cash Flow Forecasting Software, where we help the office of the CFO leave the spreadsheet behind, delivering clear and accurate forecasts to the management team. Joining me today is Mike Shum, CEO of Cascade, a platform for companies to streamline complicated and time-consuming debt processes. And today we're going to dive into the need for independently verified data that increases trust, transparency, and collaboration for everyone involved in the debt process, and also explore how Cascade solves the problem. Thanks for joining me on the show, Mike.
Thanks for having me, Blaine. Excited to be here.
So as I mentioned before we started the show, I'm like, okay, this area is completely foreign to me. So I understand, like, just sort of looking at why that transparency and data is so critical and everything. But let's start off by giving me a bit of the problem that you guys set out to solve. What is the problem that people are facing in this debt process?
Yeah, so to kind of take a step back and set the stage, the private credit market as an asset class is one of the fastest growing asset classes today. I think over the past 10, 15 years, there's been a super trend into private markets in general, right? We've seen the rise of private equity, the rise of VC, especially in the past 10 years. And a lot of the reasons for why private equity has done so well, which was, better risk adjusted returns, lower volatility, and just a greater universe of companies to invest in, all apply to private credit. And I think the BlackRock COO put it best when he said the super trend within the super trend now is an explosion in private credit growth.
Mm.
Now, what is private credit? Private credit is, to put it very simply, lending to private companies, right? And so part of the reason why it's gone is because, yes, on the investor side, the risk-adjusted returns are strong. The deal flow, there's like a lot of demand out there, and of course, some of the main drawbacks of private equity, which is in lack of liquidity, like you could be tied up for 10 years, doesn't apply on the credit side, where a lot of these deals you get coupons, you get 2 to 3 year deal times that run down. And so on the supply side of the market, it's grown. On the demand side, what's happened is, especially with, like, traditionally, you're at a company, you can raise equity, you can get a bank loan, right? But those were your two primary sources of capital in your capital stack, right?
Yeah.
What people are waking up to is like, hey, there's this whole private debt, where you're getting money from hedge funds, private credit funds, specialty finance funds, like all the non-bank sources of debt capital out there,
Mm.
are becoming more and more available. And of course, companies today, especially in a non-zero rate interest environment where equity is much more expensive, like, they need capital. And what we've seen, especially over the past, since the peak in 2021, equity markets, especially in the VC space, have been a lot more stagnant, a lot more picky, right? And even when you think
Mm.
about, the universe of companies out there who can raise equity is not that high, right? Especially from the VC, they're all looking for $1 billion outcomes. On the debt side, however, there are hundreds of thousands, not millions of companies out there who are good candidates for debt, right? And want to expand beyond just, getting a loan from their local bank, right? And so that's
Mm.
where a lot of this market has grown. And especially on the company side, right? Like, if you're the CFO of a firm and you're looking to diversify your capital stack, more and more companies are waking up to the fact that they might be good candidates for what we call asset-based financing, asset-based lending, where, rather than burdening your balance sheet with a corporate loan or something, as long as you're generating a stream of contractual cash flows, you can package those cash flows and basically sell them on, or use that as collateral against lenders, so that
Mm.
now you can tap into a much larger market. Um, so that's why, there's been a lot of growth in this market recently.
So I'm assuming then it's also like you said, just much more accessible than your traditional bank loans, which we know are can be a real challenge. And it's like you can get money from a bank if you don't need money. That's usually
Yeah, no, and
the
like the bank,
magic, right?
like the size of how much you can borrow from a bank is also usually quite small. Like, not to say
Mm.
that banks aren't involved in this space as well, right? They're getting more and more active. But a big part of it is, getting more money, right? Like, let's say you're a VC-backed company, you've raised $10 million. realistically, you can get another $10 million in debt, but beyond that, generally lenders get a bit antsy about giving you too much more than that, right?
Yeah.
But you could be a company that just raised 10 million in equity, but you might be generating a portfolio of $50 million in receivables. You could raise $50 million in debt against that. And so for the
Mhm.
same company, same financial, same balance sheet, you could raise 5, 10x more because you're focusing on the underlying receivables and cash flows and using that as the main source of investment. And that's where you can really supercharge your growth with non-dilutive financing as you scale.
Mhm. What kind of dawns on me a little bit here too is you mentioned that the banks are starting to get into this area a little
Mhm.
bit as well. So I suppose what also happens is there's a little bit more competition suddenly. Like banks see that wow, we're not the only game in town. So and I'm wondering if it does have an effect on the VC market as well, where they're like, well, maybe we can't be quite as selective or because there's other options. Maybe there's a little bit of pressure on them as well. Is that what you're kind of seeing, that is changing the market a little bit as well?
Yeah, definitely. I mean, the market prior to the global financial crisis in '08 was dominated by the banks, right? But after that, there's just been a ton of regulation, right? Banks are no
Mhm.
longer able to keep so many of these like loans, or their balance sheet just needs to be a bit more constrained, right? Especially with the latest regulations. And so the gap in the market has been filled by private credit and private debt. Because of course the demand for capital has not abated since then.
Mhm.
And so more and more, it used to be the banks were bigger than everyone else. They did all the business. Now we see banks and funds working together on deals. Banks may even lead some of these deals, but certainly the market is much more diversified across the spectrum. And you'll have different types of investors looking at every stage, right? So this is not just limited to, oh, you are a huge private company and you need access to capital. It could even be, you're a seed stage company who's just raised like a round of VC money and you need to raise your first debt facility. Like there's a huge spectrum of companies that can tap into this market today.
And so, what are some of the challenges that come along with this? That it is like it's just sort of sits in the middle between these
Mhm.
two groups. What sort of challenges and issues are a business facing when they want to actually maybe pursue this?
Yeah, so like from an investor point of view, and like we were former investors, so we understood, like we faced a lot of these challenges. Like it almost sounds too good to be true sometimes, right? Where you're like, okay, so compared to almost every other debt instrument out there, right? Like or like structures that you're looking at. Asset-based lending generally has higher risk-adjusted returns, right? Short duration underlying assets, so less risk on that. And access to a large number of different prospective companies. So what's the catch? The catch is in order to achieve those high risk adjusted returns, there's a ton of structuring that goes into these deals. A lot of like building covenants, making sure you're calculating collateral values properly, and like there's all these protections, right? Kind of sometimes we say, both the beauty and the downfall of private credit is you can structure anything. Your risk committee says, hey, I'm worried about this or I'm worried about that. You can build a specific covenant for it, but the end result is, your average asset-backed deal can take anywhere between 6 to 18 months to close, right? You
Mhm.
contrast that with, private equity deal with the same company that takes like 3 to 6 months to close. And so, you get way less deal throughput on here, which means less companies can raise. And even in an environment where it feels like, oh, there's lots of money, there's lots of people like trying to do deals, it still takes forever. And so that's a common
Mhm.
pain point. Now, as hard as it is to raise these deals, again, 12 to 18 months of someone's life is, no small amount, but there's a ton of operational overhead, compliance and reporting after the deal is closed too. So it's almost like you've run a marathon to get this deal closed, only to realize you've got another one to go, making sure you've ramped up all the infrastructure to do that. So that's a very common problem. And like the underlying root of everything is on the data side, making sure that the data is, clean, usable, standardized, and not a hindrance, not a bottleneck to any of these processes.
So I'm just I like I said, I know so little about this, but I'm kind of speculating a bit. Just I talk with CFOs every single day, and I know a couple of them have mentioned that um, when there, and I believe this was more maybe working with the bank or a line of credit or whatever, but there was lending against assets that they're receivables, but there's only specific receivables that sort of
Hmm.
counted, right? And so it was pretty fascinating to me that there was how, in a way, sort of how granular they would have to
Yep.
really track things and report things. And there was, I guess, sort of like your gold standard receivables, and then your ones that maybe the bank doesn't trust as much. I imagine like that. There's probably quite a number of different factors that come into this at a much more granular level than we can even imagine.
Yeah, no, absolutely. You're right. There's a ton of detail in this stuff, right? In debt, it's all about the details. And so you can specify specific receivables that you'll take and have a long list of eligibility criteria or concentration limits to just even define your borrowing base or your collateral values even before you do anything else. And so not only is it hard to get to a conclusion because like everything is being done manually generally, right? But
Mhm.
afterwards, you got to do reporting on all of these. And so a big part of the challenge is in making sure your reporting is done correctly, right? Because unlike equity, right? Like if you don't send your equity investors an update, and like by and large equity investors don't even ask for that much realistically anyway, right? Like but there's no
Mhm.
ramifications on the debt side though. It's a completely different relationship, right? Your debt investors don't have unlimited upside in you. They don't have a equity stake in you at all. And so their primary concern, and like a common phrase in our business is, on the equity side it's about your winners, on the debt side it's about your losers and how much you lost on them, right? And so on the debt
Mhm.
side you're thinking, they're trying to reduce risk, they're trying to mitigate losses, which means if you don't send the right information, or God forbid you send something that was wrong and they considered, oh, is this like potentially fraud at this point? Like in a worst case scenario, you have an investor who's just trying to get their money out as fast as possible. I've talked to CEOs, CFOs who've lost their company as a result of not doing the reporting properly, either because they couldn't fund a lot of the receivables that they were planning to because, it didn't fit the criteria, or they didn't meet the reporting requirements, things breached, they didn't even realize. And before it was too late, the investors did what they had to do. They had a fiduciary responsibility to get their money out, right?
Mhm.
So that's a big reason for why we exist, is to make sure that the reporting, the compliance on these, which is very complicated, very complex, right? It's like almost
Yeah.
a completely different language you have to speak, even if you're used to doing like dealing with financials. Um, we automate all of that and make sure that you're on the right side and you have transparency. Like the other thing I'll highlight is, the standard today in the market is, how is this reporting done? It's not on a spreadsheet, right? You got like a monthly or quarterly spreadsheet with all these values. Someone on the borrower side, they have a team that builds these things again manually. They're trying to pull, and like I've heard from a number of companies where it's a big drag, right? Like because either you have to hire more people to do this stuff, or you have to dedicate engineering time to build purpose-built dashboards for this stuff. And honestly, that's not a good use of any company's resources, right? So
Yeah.
um, and even the end result isn't that great. So part of what we do is to make sure that, hey, let's save time, but also do it in a different way. Go from spreadsheets to that are updated once a month to, data integrations that give you almost real-time insights in terms of where are you on a deal, so that you're never caught unaware of, oh, I have a breach or I have a deficiency that could, cause me to lose my company, basically.
Yeah, yeah, it's like just thinking of the like you're saying the complexity, and when you said there's an entire team dedicated to it, yeah, I could see that because um the timing issues must be like if you're doing monthly reporting, but those receivables are turning over
Hmm.
everything's changing basically daily, and I imagine the recency of the information is really critical, and yeah, companies shouldn't be trying to turn themselves into software developers because
Yeah,
it
like
never
debt
seems to quite
software
work out that well,
developers,
right?
especially, right? Like it's just
Yeah.
not in their wheelhouse. Even if you have great fintech engineers, learning about borrowing bases, covenants, advance rates is just, a completely different domain.
Hmm.
And just the amount of data, right? Like we now get data files in the gigabytes of size, right? You couldn't even open that in an Excel spreadsheet anymore. So,
Yeah.
and that's kind of the trend, right? There's more and more data being created. There's more and more, things that need to be tracked. And so things slip through the cracks unless you're careful.
Yeah. So I just want to dive in a little bit with like how you guys solve this problem, and
Mhm.
just a little bit of insight on, first of all, just like the problem itself. We'll sort of go into how someone would engage in that later, but how did you come up sort of with this idea, and then how did you start to tackle it?
Yeah, so as I highlighted a bit at the beginning, data is kind of the core of all these things, right? If your data is bad, it's garbage in, garbage out on your reporting, makes you look bad in front of investors, and it probably leads to knock-on effects everywhere else, right? So step one is to make sure the data is correct. What we do is we instead of using spreadsheets, we plug in directly into systems, or we take the raw data. And because we have a lot of domain expertise in this market, we'll do the heavy lifting of standardizing, cleaning, validating the data, right? We look at ourselves as we're the data layer, we're the translation layer between borrowers and investors because they're speaking different languages right now.
Mhm.
And there's also, as they find discrepancies in different things, the trust level goes down, which makes it even harder to do these deals. And like, even if you've already done the deal, well, you're looking to renew next year or something like that, right? Those conversations are much easier when there's confidence in what everyone is tracking. And so our expertise came from, we ran a private credit fund for 5, 6 years. And even before that, my co-founder was employee number one at a fintech that did alternative credit scoring in emerging markets, right? And so if you're building credit scoring, what's the number one thing is you need to have good data to be able to build credit models, right? Like building the
Mhm.
credit models is actually not as difficult, right? Especially in the age of, machine learning algorithms being available in like, vanilla Python libraries, right? Like it's the secret sauce is how do you make sure the data is usable? And so that muscle of taking data, cleaning it, validating it, standardizing it into something usable is something that we've been working on for probably over 15 years at this point. And we do it automatically on our back end. That's why we don't even ask for data to be in a certain format because we realize that like if they had to convert their data into our format, we're just going to get even more translation errors that way. And
Mhm.
so we'll work with raw data, we'll clean it. And then of course, with the perspective of having been an investor or having worked on the originator side to really highlight, okay, where are the things that don't make sense and where are the potential errors here so that by the time it gets to an investor, they have full confidence that it's been vetted by, a neutral third party. And on the originator side, we're working with them hand in hand to make sure that the data and the quality of the reporting and what they see, how things are going, is, done properly.
Mhm.
So
So, and I'm just sort of curious, how do you know, or how do you sort of monitor the data from the client side that they're actually like they're keeping it up to date, that are,
mhm.
because we've ran into businesses, sometimes you get a new CFO that comes in, I just came
Yep.
into this company and they're 5 months behind, and
Yeah.
they're so frustrated. And so I imagine you must have some requirements of them that you guys have to be up to this point for this to actually work.
Yeah, and so we work with them to set up data pipelines, right? Step one is making sure that no one has to manually upload stuff on a regular basis because, none of us are disciplined enough to do that on a daily basis and not forget, right? And so we set
Mhm.
up automated data pipelines where we're getting raw data straight from their systems. And then from there, we'll do the heavy lifting of, getting it onboarded into our platform. So that's the main step in terms of making sure that they're on top of everything. And then from there is like the training process, walking them through why these things are important, helping them even to structure these deals, making sure like we're back testing everything. And then of course once they close a deal or if they've already closed a deal to make sure that they're on top of all the reporting because we'll automate all those reports for them going forward.
Mhm. And so, like, I imagine that is there sort of any limitation to the type of sort of data warehousing you can get to, or is it just like pretty agnostic? We can plug into just about anything.
We're fairly agnostic, so we can work with over 20 different types of cloud databases, right? As long as their data is on the cloud, we can find a way to sync it. Or
Mhm.
we can go old school, set up a pipeline where they just dump CSVs of raw data into there on a regular basis. we work with it from there. And in terms of the underlying, asset types that we can deal with, again, we're agnostic. Whether you're doing, loans like small business, consumer, invoice financing, that's not a problem. Whether you have, inventories or anything, like as long as we have the data, as long as there's a contractual stream of cash flows that need to be tracked, which, more and more the world runs on, we can track
Yeah.
it. We can get it into the right formats and translate it into whatever investors need.
Yeah. So who should be getting in touch with you? Like, tell me a little bit about the types of businesses, the size of businesses, the location, everything like that.
Yeah, so in terms of the types of businesses, we have two main types of businesses that we work with. One are the borrowers and one are the lenders, right? So on the lender side, I'll start there. It's like the investors, private credit funds, specialty finance funds, anyone doing debt deals who want to get into asset-based lending or are doing asset-based lending, we work with. We work also with like venture debt funds, corporate lending, loans, that type of stuff as well, to be almost like a system of record for them or like a calculation agent on deals to make sure that even if they have their own systems, that the data going into there is being done correctly and we can reconcile against what they have. The other side is, of course, the borrowers. So who are the
Mhm.
best candidates to raise this type of debt? It's going to be companies that either have portfolios of receivables, right? Or want to take out some sort of asset-based lending deal. Why those deals in particular? It's because it's a lot more structured, it's a lot more complex, right? A lot more moving parts. If you're just taking out a venture debt loan or a corporate loan or something like that, it is going to be more straightforward and you might not need us, although their investor would still use us to collate everything and keep organized there. So those are the two main counterparts. In terms of market, the US is our biggest market, but we are global. We're active in LATAM, Africa, Asia. It's a global market, right? A lot of the investors we work
Mhm.
with also have global mandates, but a big part of our vision was to democratize access to this in asset class, right? And so we work with even very early stage companies across the globe to, get them up to speed, not only on the data side, but of course on all the debt related things too.
Yeah. And Mike, how should people get hold of you if they want to learn more about your services, talk with you, or talk with one of your team? How should they find you?
Yeah, just shoot me an email, Mike at cascadedebt.com, or visit our website, cascadedebt.com, for more information. Would love to have a chat. And, even if you're like, hey, it's not the right time for me to have a system, we're always happy to help companies with, reaching into the network, right? Like a lot of times you need to raise debt, great, but you don't know who to talk to. We're happy to put you in touch with a number of investors in our network, free of charge, or to do like a quick feedback call on, hey, this is how we've structured things. This is how we're thinking of raising debt. Happy to give you that feedback in the interest of like growing the ecosystem.
Well, thank you very much, Mike. This was really interesting. I learned a lot. Actually, I was get into these shows and I just start asking questions and I forget I'm recording half the time. But it's interesting stuff, and I really appreciate your time. And certainly reach out to Mike at cascadedebt.com. I'm sure he'd love to hear from you, and you can see if this might be a fit for your business. And I
Perfect.
also want to add, if you are a CFO and you and your team are buried in spreadsheets to do your weekly cash flow, come and talk with us at Dry Run, because we will save you hours every week, and we're going to help you give something crystal clear and presentable to the management team.